to the Rust Belt Real Estate Podcast, conversations with real estate professionals focusing on the Midwest markets. Today's guest is Tim Jackson, MAI Appraiser and Managing Director of Integra Realty Resources, based here in Cleveland. Actively engaged in real estate valuation and consulting services since 2013, Tim works with various property types, including single and multi-tenant industrial and retail, mixed-use facilities, subdivisions, student housing, vacant land, and of course, my favorite, multifamily apartments. Tim, welcome to the podcast.
Thanks, Peter.
I'm excited to have you. You're the first appraiser we've had on the podcast. No pressure.
Yeah, well, sorry.
But I'm looking forward to discussing market trends, past, present, and future through your lens, through that appraiser viewpoint. And I think your listeners will certainly benefit from it. First, tell us a little bit about Integra Realty Resources.
I think you summed it up pretty well. We do, obviously appraisals, market studies, just general consulting. Kind of whenever somebody wants maybe an opinion that isn't from a broker or someone that maybe is more involved on the transaction side, they'll typically call us for some help in valuing stuff. But I think bread and butter, obviously, we do a lot of appraisals for lenders, attorneys, and any type of client who would need an appraisal. We do Fannie and Freddie deals, conventional banks. There's a whole other side of non-lending that we do as well. In terms of litigation type appraisals, but pretty much anything involved around appraisals and valuation of real estate, we're here for.
So I think the assumption a lot of folks have, certainly newer folks to real estate, is that appraisers are these people behind curtains that no one can get in touch with unless you're a bank or an attorney. And I want to make it clear that folks can, owners, operators, even someone interested in real estate can reach out directly to you, correct?
Yeah, no, I always sort of hint at that as well. It's like, I know a lot of times, especially if we're not meeting a broker at a property tour and we're meeting an owner, it's like, oh, this is the first time I ever met an appraiser, they'll say to me, or, it's like, oh, it's amazing to meet an appraiser. You're an appraiser. They love to kind of, sort of poke at you a little bit because they've never either met one or know one. So, I like to socialize a little bit more, and I do like to put a face to the appraiser, and hopefully, going forward, if anybody ever needs to get in contact with an appraiser, I'm here and more than happy to talk.
Yeah. You always take my calls when I'm begging for comps.
Yeah. Well, and conversely, I know we might get into it later, but one of the things that I love to say is, it's a two-way street, right? Like, you answer my calls, I answer yours. We're all trying to help one another. And it's honestly, it's for the benefit of everybody's client, right? Your client, my client.
Agreed.
And in a way, it makes the market a little bit more efficient when we sort of talk through, any of the deals you're working on, maybe a deal I'm working on the valuation side. But, talking to yourself and many other brokers in the market, I have to say our market, at least in Cleveland and Ohio for that matter, the brokers, they're willing to talk. They're not shy. And they generally will pick up the phone, not every single one, but the ones that I usually deal with, you guys pick up your phone, you answer your emails when I'm looking for either some help or just some, some market, knowledge in terms of what's maybe happening today, as opposed to, we're obviously using historical data, right? So, obviously last year's data might be outdated, and that's why maybe I'm reaching out to you to say, hey, this sold last year. What are we looking at this year?
Sure. I think it's a nice segue into a bit of a look back. I wanted to spend some time on today's episode discussing 2023, which, for a lot of investment sales professionals, for a lot of real estate professionals, certainly on the commercial side of things, it was difficult. My transaction volume slowed. We got deals done, but they took longer. It seemed like you worked harder. I know you stayed busy, but can we just open it up to some of the trends that you saw the past 12 months and your thoughts on that market?
Yeah, I think a lot of this is sort of I think a lot of folks listening to this probably are aware of a lot of things I'm probably going to be saying, but I do think there's some items here and there that maybe are some nuggets. But
Okay.
obviously, I think looking back at 23, the biggest thing that happened was obviously late 22 rates started rising, and then they were just rapidly rising throughout 23. There was a constant, I would hear from guys like yourself, working on a deal, you get a deal signed up and it's, 2 months later, you're trying to get to the clothesline and rates were up 150 basis points or whatever they might have been up, right? They've just, and then they would kill the deal, or it was, seller had to maybe come down on the price, or the buyer had to come in with more equity because the banks didn't want to, couldn't lend because of, debt constraints and whatnot. So there was a lot of that happening. Um, and I think another theme of 23 was just the total mismatch of, buyers wanting these steep discounts, sellers wanting, 21 and 22 type prices, all-time high prices. Still, they're thinking, hey, yeah, I'm still cash flowing. I should be able to command the pricing that I saw last year. And because of interest rates, mainly, not the only reason, but interest rates really had an effect on the valuations that buyers could pay for an asset, uh, and and that was a constant theme of, like I said, just the mismatching and the runaway rates
Mm.
on guys and
Yeah,
gals.
certainly saw a buyer seller disconnect. Unfortunately, still see a little bit of it. You've got
Oh, yeah,
some owners, some sellers who are grasping on to 2021 as
yeah,
hard as they can, and that's a reason their properties are sitting.
yeah. No, 100%. And I do think that mismatch is starting to get bridged a little closer. I think it was a huge gap. It seemed there was a strong gap between them. But I do think it's starting to shrink a little bit. And I think it's partly, buyers are willing to, rates are starting, at least today, rates are starting to settle. And I think buyers are more comfortable. And sellers are realizing, hey, if I want to move on from this asset, I'm probably going to have to list it a little bit lower than what my expectations were, a year or two ago. So I do think that sounds, when I talk to guys like you, in the market, brokers, whatnot, it does seem like that mismatch is starting to come back together. Not as it's not as dispersed from one another, but obviously there's still some stuff that needs to be worked out between the two parties in terms of what valuations buyers and sellers are seeing.
With the slowdown we saw last year, obviously, as you discussed, a big part of that was the rate environment. Did banks add any additional measures of tightening that may have slowed down deals, prohibited deals?
Not, I would say nothing that was like a mandate from a lender, right? I mean,
Mm,
one of the things is we're obviously, as an appraiser, doing an appraisal for a lender. We have to be sort of separate, and there can't be any influence on us, in terms of pressures from anybody in the process. So they can't specifically direct like, hey, we don't want to see this kind of cap rate, or we don't want, but I would tell you one thing that maybe is a little bit more, from what I can tell, lenders are underwriting to is not the pro forma. I think oh, this guy's owned the property and it's at $800 average rent, and we think it's 1,000 in the market. I don't think lenders are buying the $200 a unit, per month increase on the pro forma when they underwrite their deal. It doesn't mean that as an appraiser, we can't value either, based on market or some sort of, maybe a 50-50 ratio of what's in place and what could be the potential. But I do know that, that's one thing that it seems like when I talk to some participants, they're getting a little bit more pushback on that end in terms of the back end of underwriting.
mm.
And I think again that goes back to you know the debt service coverage ratios. One, it's twofold. So your debt is obviously more of a burden with rates being higher, and I think banks are also lending instead of the 1.2, it's 1.25, 1.3, maybe even higher. Just really depends on the deal, right?
Sure.
And it is higher in a lot of deals. So you're seeing like that double whammy effect of rates going up, debt service coverage ratios going up, and it makes it hard for deals to pencil, with an in-place rent when there is an obvious, gap between, there's legitimate reasons why, owners had the building for 30 years, has tenants that have been there for 25 years, and they're all paying $200 below rent because he likes them and, doesn't want to raise the rent, right? He hasn't kept up, or she hasn't kept up with her property in terms of raising rents. So yeah, there's always a story there, but I don't think banks are necessarily just automatically going to take that market rent and put it into the underwriting. They want to see the in place, and I think they give it good weight.
There's probably no question that this run up we saw in the past 10 years, values, appraisals and stated values are keeping up with each other.
Yeah.
Is that a fair assumption?
I think especially, like over the last 10 years for sure. The market has been steady with obviously post COVID interest rate decompressing, it really ramping up during those couple of years. The market really ramped up. But it was steady increases throughout the past 10 years. It wasn't like we only saw increases because rates went down. We definitely were seeing significant increases in property values before COVID interest rate decreases. So I think overall values have, and our market isn't, you read headlines and it's totally towards different markets, like your Sun Belts or, your Californias and Florida, it's like they're much more speculative, I think, overall, and they're much more, they've got institutions putting money in. Cleveland, at least, doesn't have a ton of institutionals that are investors. We have our, we do have some, but we're not predominantly institutional asset.
Sure, the metrics just aren't here.
Yeah, exactly. And so with that, I just don't think you see, like, that doesn't mean that we have no, crazy buyers in our market that are maybe overpaying on stuff. It doesn't mean that doesn't happen here, but the predominant buyers are local and regional. They tend to understand our market. They do a good job of underwriting. We're not seeing too many deals where, they're sort of pie in the sky numbers that are, sort of unbelievable. It doesn't mean that, again, that it never happens. It does happen on our market, but it's a minority of the deals, I guess, is the best way to put it. So, we also don't see huge demand swings in Cleveland, right? We're steady Eddie. For the longest time, we were sort of losing population. I think now we're starting to see a flatlining to maybe even a slight increase, ironically. But when I say an increase, it's 0.2%. Sure. So other markets in the Sun Belt, they see 10% growth or whatever. They're seeing population growth that's 10x us. So we don't have that, and so that, like you said before, the fundamentals just aren't here for crazy speculative investments. So,
and we don't, and because of that, we don't see those swings. And you used a phrase, steady Eddie. I use that all the time when describing our market to out-of-town buyers who are looking to the Midwest, looking to Ohio. And we don't see the wild swings that Sunbelt markets, coastal markets will see, for better or for worse.
Yeah, no, 100%. And I think if anything, some of us up here get spooked by Columbus. We're like, wow, look at what's going on down there. And then you look and you broaden out to a national viewpoint of Columbus, and they're doing extremely. Columbus is killing it.
Yes,
but even they're not getting major they're getting some institutionals for sure. Much more than what we're getting. But even you talk to some of the guys down there, and it's like, some of these institutions, it's like Columbus just doesn't attract them, which is crazy because I think they got great fundamentals, but they're just not gangbusters like some of these other markets are.
From a growth perspective, mostly.
And I think they're underappreciated. I think it's more of a maybe an underappreciation for what Columbus is doing. But But I know, there's a lot of guys up here. I was just talking to somebody yesterday on the phone. He's building apartments down in Columbus. I mean, I'm seeing, a lot of names that are Cleveland names building in Columbus.
Interesting.
And they're finding really attractive deals on new construction. And honestly, all of them, if you talk to them, they just mention Intel. That Intel plant was like a huge. I mean, obviously it's a major event that Columbus was able to, to get in order to see a major job. But yeah, I mean, it's going to be interesting to see how that plays out. Ironically, I saw yesterday. I think Intel might be pausing it, but I think it'll through. There's some major defense things I think that get into that. I think the United States has some interest that they would like to see that get done. So overall, nonetheless, I just think Columbus, even they're doing very well. I don't think they're getting the share of institutional investors that other markets that you read on the national headlines do. So again, it's Columbus is not as steady Eddie as Cleveland might be, but they're not even we think they're gangbusters. From a Cleveland perspective, looking at Columbus, like, oh wow, they're unbelievable.
Mm-hmm.
And you brought them out to a national, they're like, they're doing well. Like
Texas is like, hold my beer.
Yeah. Right? Yeah, but then you see things in Austin and you're like, yeah, I mean, they're building
Houston,
more homes.
Dallas, Fort Worth.
Yeah, it's so what I'm getting at is we just don't have the major speculative, especially in Cleveland. So
any final thoughts on 23 lessons learned? I mean, owners, operators.
I think it's a very constant thing that everybody hears, right? It's like I talked to some investors. One of the I can remember the one gentleman I spoke to. He's like, I asked him. I said, "Are you guys active in looking to buy?" They're a regional player. They do stuff in Cleveland and Northeast Ohio, and he's like, "Yeah." He's like, "We'd love to buy a deal, but every seller wants a 5 cap on their underwriting." And he's like, "We're getting 5% in the bank. Like, why would we ever do that?" So, I think that's a constant thing that I hear. Obviously, I think family offices in 23 really stepped up as buyers because of they're not as constrained by debt. A lot of times they're either majority cash, all cash, whatever it might be. They're depends on the office, but they're not as reliant upon debt. So they were active in 23, and I expect them to still be active in 24. And obviously, the biggest thing that changed in 23 going into 24, really more for 24, that is the tax abatement in Cleveland. That's changing. How that plays out, I think it's going to be, a wait and see. There was obviously a major rush of builders in our market to get their plans in, right? The city of Cleveland came out and said, "Hey, if you get your plans into us, you're going to be grandfathered into the full 100% 15-year abatement." That changes if you submit plans now in 24 and on, and it does change quite a bit. I mean, there's the benefit of the abatement prior to the change was very nice, and the abatement moving forward is still nice, but obviously not as good, right? In terms of an investor.
And Tim, just so if I may interrupt, just so our listeners are aware, the city of Cleveland has instituted a new tax abatement structure, correct, where it's a tiered system.
Yep.
And no one's getting 100%.
Certain neighborhoods will still get 100%, I believe, but your Ohio City, University Circle, they're not getting the full 100%, which is where we've seen a lot of that abatement utilized. But again, I think there's been a rush of plans submitted. So,
to preempt that sunset.
Exactly. So they're grandfathered in. And so, like when somebody says, "Hey, what do you think the effect is going to be?" Will there be less construction or what? It's like, well, if 15 builders submitted their plans before the end of the year and they represent another 15 to 2,000 units or something, right? It's like I don't know how long of a leash the city of Cleveland gives them to finally get going in order to still qualify for that 100%. But I think it's, going to be at least a year or two before they have to move dirt. And so with that said, it's, I think you'll see those projects get built in the next couple of years potentially. and it's going to take a couple of years to see what do developers and builders pay for dirt under this different abatement. That's one thing I'm curious to see. And then I'm also curious to see, how does the valuations change when, does the feasibility of, not, I'll take a step back, but in appraisal and anybody for that matter in real estate, financial feasibility is a major thing to achieve on any new construction. So moving forward, it'll be interesting to see. A lot of times when we're doing an appraisal, it's the feasibility is achieved because of the tax abatement value. So a new construction on its own merits isn't necessarily feasible if you are doing a new construction and assuming you're paying your market share of taxes. It's feasible. The feasibility is achieved because of the tax abatement. And it's truly as simple as that. There's nothing else I can say other than tax abatement equals feasibility for multifamily. And again, there might be some one-offs that can be achieved without it, but almost every single project, I think every single one that we've done in the past 10 years, the only way feasibility was achieved was through that tax abatement program. So I'm curious to see when we start to factor in the new abatement moving forward, is feasibility still achieved? I think it could be. Obviously, rental rates have increased significantly.
Sure.
And valuations are higher. So I do think feasibility can still be achieved with the new abatement, but until we go through a full underwriting, I don't know. So it will be interesting to see how that works. And just because we as an appraiser say, hey, we did our underwriting, it's feasible, doesn't mean it meets metrics for, investors to build, right? Their IRR might not be there, whatever it might be. So there's a other aspect other than just, is the value feasible, that needs to get put into that equation too. So that's, I think, looking back at 23, looking forward, that's an interesting market dynamic that I think won't be played out in 24, but more 25, 26, we'll start to see how that affects it. And I'm actually, just as a real estate nerd, I guess, I'm more curious, do people pay less for dirt? Or vacant buildings, right? I'm just curious if the values there become a little bit less, or does it still remain steady, even with the new abatement? So,
That new abatement structure, certainly, at least I've heard from some, local and regional developers, is that it will hurt your quote unquote mom and pop shops.
And I would agree. I mean, if you're taking away a tool or lessening that tool, of course, there's only a negative to the developer or the builder. So that's just how that equation works. But it doesn't mean that the city's wrong. It doesn't mean that things are just going to come to a halt either. And that's what will be interesting to see. But again, I think there's so many projects now in the pipeline within the city because of that rush to get stuff in that I don't know if we're going to really see the effects for a couple of years. But I do think what we might see more immediate is, developer builder looking at dirt or a vacant building today. How do they look at that today as compared to, if they don't have plans submitted and they're under the new abatement, they're obviously going to have to find, some savings somewhere along the line that maybe they didn't have to before. And an obvious one is their basis. What's their land? What's their shell building? Whatever it is that they're looking for. So that'll be an interesting thing. And then obviously the other thing that I still have to see how that plays, the new TIF that Cleveland's proposing. That's a broad-based TIF throughout downtown and the riverfront. I mean, there's a lot of things that are starting to come into play that I'm like, again, as a nerd, I'm intrigued to see how this stuff starts to play out in our industry, and how we continue to achieve feasibility in the projects that are being proposed.
Well, it's a great segue into 2024. So we touched on development. I was chatting with a Collier's colleague at an event a few weeks back. We were discussing 23, and we had both had similar 23s. They were considerably down, a lot of folks on the sidelines, but we both agreed that Q4 of last year of 23, we started to see what he described as a thaw. And that is a term I like. I'm going to continue to use it this quarter. And next, hopefully I'll stop using it because we will fully thawed. But and I agreed with them. More activity from a buyer side. I think lenders are a little more fired up on deals. What do you think about that? Do you agree that
Yeah,
we're starting to see a bit of a thaw heading into this year?
I generally would agree. I think it's still sort of a wait and see. Generally, I mean, I don't think anybody's Nostradamus. Nobody knows exactly what's going to happen. But I would say, looking at the 23 dynamics that were at play and looking at what we're seeing in 24, and at least what's maybe generally being perceived for the market this year in terms of obviously the Fed as a major player in that, I do think, yeah, we should see a little bit of a thaw. I still think it's going to be a rough first half of the year.
Mm.
In terms of volume, in terms of deal flow, I guess is a good way brokers would talk about it. I do think it's going to be a little bit slower the first half, but I just think there comes a point where, capital's got to be put to work. And I think rates will remain. I mean, I don't know what rates will do, but my perception is they're going to remain steady. The Fed came out and said they're not planning to raise rates again, but they also didn't say they were going to lower rates. And I think that's them saying, hey, we're just going to be in this sort of interest rate environment, which is, relatively speaking and historically speaking, it's kind of normal. It's not crazy high rates. I think we had a lot of people get used to these, for a couple of years, to be frank, they got used to low rates, easy, cheap debt that could finance pretty much anything that was out there. So I think investors, generally speaking, they're going to have to adjust to a little bit higher interest rates, but they're not crazy high that, I'm sure everybody that's under, 40 or whatever, they all heard their parents tell them, oh, I bought my first house and it was, 15%, or, you hear the one like crazy guy, it was 25%, it's like, okay, that's a lie. But, I do think that, historically speaking, the rates are fine. So it's just getting everybody adjusted to it. And I think it'll be good. And the second half should really thaw out. I hope too, for everybody's sake. And I hope that we start to see that deal flow come back and activity and transactions come back. But yeah, I think until everybody sort of realizes that this is the new normal and it's not really that new of a normal, it's kind of normal. And I think it'll be okay.
Yeah, I like that point you make of folks who perhaps jumped into this low interest rate as their first foray into real estate. That was normal to them, and this is crazy.
Yeah, no,
it's actually quite the opposite.
Yeah, it's crazy. And I mean, I can remember seeing, some investors, DCFs would be like, they would have a cap rate in place for their project of like 4.5, right? They'd be like, our cap rate today, we value with the 4.5 cap. Our exit cap in 5 years or 7 years, whatever their whole time, it'd be like a 5 cap. And I'm like, man, we don't really get into like what is the value in 7 years. That's sort of, but investors have to think about it, for their rates of return. But I'm like, man, a 50 basis point, spread between today and 7 years when you're in a historically low. But I mean, rates at that time only had one way to go, and it was up. It wasn't me saying I knew they were going to go as high as they did. That's not what I'm saying. It's like, I think some of those lessons, they're going to be a hard lesson to learn. But yeah, I think that wasn't enough premium baked into their terminal cap rate, as we like to say too. So, that's again, we'll see how it plays out in the next year or two. But I don't think there's a ton of those I'm sorry. I don't think there's a ton of those investors that underwrote that way, to be honest. But there's a few, there's a few that I think did. And they're going to have to figure out how to either get back into that deal on a refi or get out of it.
So you and I almost always talk multifamily.
Yeah.
Let's broaden it a bit. Looking forward to 24, your thoughts on asset types, who's on solid ground, who's still finding their footing? What's your take?
I think so office is hurting, but that's broad based. I think it's not as bad here as your San Francisco's and your maybe even New York's, but I I think even New York will be okay. It's New York, right? Like it's hard to believe it's going to die off or whatever. But they're going to. I mean, I think everybody's going to have to realize that there's a shrinking in the space needed, and I think it was already happening before COVID, but it obviously got ramped up. And I think it's coupled with you got more of a folks working from home 2 to 3 days a week. But so I guess what I'm saying is, you don't need as much space in theory. But I still think that a lot of these corporate, we're seeing them. I mean, I saw UPS. I see a lot of these corporations start to say, hey, we need you back in the office. And I know some folks want to hate on it. Like, hey, I can do my job at home and I'm just as efficient. But I do think what they're starting to lose is the culture that you can build. And I know it's hard for me to go on I'm not carrying the flag for UPS here, by the way, but I think all of the mid-sized companies, like they do develop a culture. Like Colliers has a culture.
I agree.
We have a culture, and I think
I agree.
that's one thing when everybody's home you can't do. And the training, right? You get a new hire, it's like you're gonna train them on Zoom, you're gonna train them on Teams, like that seems miserable. And I'm young, I don't want to. So I do think you're gonna see this like change in how corporations look at office space to where, in a weird way, they might almost value it more because again, they're maybe losing sight of their culture. They're starting to realize it now. And they're like, hey, what? I think we need to get people back. So office, generally speaking, it's hurting, but I think longer term, it might have a little bit of a bounce back. And by that, I mean, I don't know if it's ever going to get back to the valuations that we saw, for Class A type assets, multi-tenant office. I don't know if they'll ever get back to those, especially in our market. But we were already a market that office wasn't a hot asset, right? I mean, I can think of times, going back to that financial feasibility that we talk about, and it was, you would try to build the spec, in appraisal, you'd go through the highest and best use, you do these calculations, and in one class I took, I'll never forget, there's a guy from Boston, and we were going through highest and best use and financial feasibility, and he was like, yeah, it's always feasible in Boston to build an office. Like we were doing an office project. And I was like, no, I don't, it's not feasible in Cleveland. And they were like jaw as if like, what? And I was like, I mean, first of all, it's Cleveland. Like, we haven't seen growth like Boston and, but second, I was like, yeah, the cost, and I said, our rents are nowhere near, they're showing market rents in Boston. And I'm like, our rents aren't anywhere near your rents. So it's just on that, it might be half of it. And that's on a good day. And that's if you get, so really feasibility on office has never been achieved in our market for a long time. The only way you achieve it is if you had an owner user, wanting to go in on themselves. So they're building, like how Sherwin-Williams is doing now.
Sure. Okay.
Or you pre-leased it. So there's a company that said, hey, I need new office space. And so therefore the developer had, essentially pre-leased the entire office, or at least the majority of it, to make it feasible. But it's hard to build a spec office building in Cleveland, for the last 20 years, to be frank. So, we haven't had too much inventory come onto the market, that wasn't spoken for at the time of construction, essentially. And a good way to look at it too is if you look at Cleveland's inventory of office space, it's shrunk for the most part. So, and the reason being is obviously, especially downtown, the downtown office space has shrunk. So, I mean, we're in the, you read the one thing that you do see Cleveland on is in the national news is the fact that we've been able to take down so many office buildings and convert them to residential. So the conversions, so it's weird. So in Cleveland, the inventory has shrunk and the demand has kind of shrunk too. So you're seeing relatively stable occupancy in downtown. Obviously, this is before COVID. When I talk about this, it's before COVID because I don't think anybody truly knows what's happening still. Because of and it's going to be a couple of years before leases start to roll off and all that, But again, before all this craziness, Cleveland was losing space, but remaining steady to maybe even a slight decrease in downtown specifically in terms of demand. So your implied vacancy was either stable or even somewhat of a decrease. It doesn't mean that there was better demand. There's actually less demand or flat. So we're more unique than what you would see in like a Dallas, right? Dallas or whatever other market where they're building, but they're also getting demand on the back end. So office, we'll see how that plays out. I don't think anybody knows exactly, but there's not a lot of positivity, but I do see some little glimmers of hope that you're starting to see companies maybe go back to valuing their office space, right? I think they were like, hey, everybody's working from home. I could save money on my real estate. This is great, for the bottom line. And I think they're now realizing, you know what, maybe I do need some people to come back in to get things done a little bit more efficiently. So that's office. Retail has been great.
Retail's been strong.
Yeah, it's been great. It was sort of not loved, before COVID. It was sort of the Amazon is going to take over all of retail. You're never going to need to go to the store again. Everyone's just going to buy their stuff. And I think that maybe was overdone. Maybe like office could be overdone, the sentiment there today. But yeah, retail's been strong. I will say, one thing that we're seeing that hasn't happened in the past is landlords are willing to do TIs for tenants and for retail. They're obviously willing to do it for office. That's a whole other topic too. But usually retail has always, and not always, but usually retail, you'll see the tenants do the build out. Landlords are willing to do the build out to attract the tenants. So overall, retail is doing well, but there's still competition in that segment. But overall, yeah, it's done well. I think the doom and gloom of the Amazon takeover hasn't really come to fruition like everybody thought it would, and it'll be okay. I think it's a good asset class, and it should remain steady. And again, this is more our market. I don't know what nationally everybody's doing, but I think locally we're doing well within retail.
I want to get before we jump off of retail, I just want to see if you have any insights or thoughts on a recent trend that I was chatting with a retail broker, Chris Seelig, in our office about earlier this week. And that's the closures of several of these Rite Aids, Walgreens. What's going on with these pharmacy style, I guess pharmacies, if you pharmacy retailers?
Yeah, we've done some work on some, we like to call them dark, pharmacy, drugstore buildings. I think Rite Aid in specific, they've got some obviously company issues just in terms of what their company metrics are.
Okay.
I think they largely have some issues just with their business model, but and I don't know what I think they might. Who knows? They might get bought, or I don't know. But I do think Walgreens and CVS are a little bit more stable as a company. Especially if you look at like their bond ratings and whatnot, their credit ratings. They do better, but I do think they are finding that maybe they don't need as much space, and so and maybe they don't need to be on the corner. Like they're always on a corner. I don't know if they need to be on a corner. So I think they're willing to maybe not pay the quote premium for the corner, but I don't know. It's definitely I think it's also one of those. They want a lot of these companies. They kind of want that newer construction. So if their drugstore is 20 to 30 years old, and the landlord's not willing to kick in the TIs to make it look nice, why wouldn't they just go with a developer and build a new one, down the street or whatever it might be? Obviously, not every single location you can just move down the street, but that is one thing that you're seeing. And I also don't know if they need as many. I don't know if Walgreens needs to be 2 to 3 stores in every city or what. Not that they're in literally 2 or 3 times, but there's a lot of times where you're like, I drove by one, I drove by another, I drove by another, and it's like within 3 miles. You're like, wow, So
how does that make sense? Yeah,
exactly. And I think they're just as prone to some of the larger retail trends going back to the Amazon. People can buy their drugs online. If you're getting a reoccurring drug order for whatever you might have, you don't need to go to the States. Kind of like you're happy that you don't have to go back to the pharmacy.
Sometimes you can't go
every month or whatever it might be. Right? It just comes on my doorstep. That's great. So I think they're losing a little bit there. And I don't know. Yeah, they're going to be an interesting one. We've consulted on a few of those, and to be honest, it's sometimes the wild west, right? Like nobody really knows. And I think in terms of what that renewal might be, a lot of times you're like, oh yeah, they're a surefire renewal. The store's doing really well, and then all of a sudden it comes up and they're like, yeah, we're not interested. And then it's the vice versa. We're like, well, I thought for sure they weren't going to renew, and now they did. So
Interesting.
I don't know. I would, and I'll be honest, I don't do a ton of those deals, but we do enough, and I'd be interested to see what some brokers really have to say about what their experience is. I mean, I know there's some very active brokers in our market that do that, and it does seem like nobody knows for sure, but there's definitely a weakening there.
Yeah. Okay. How about industrial?
Industrial's doing well.
Strong footing, right? I
Yeah,
mean,
it's on strong footing. I think industrial's doing well. We're not building. I mean, going back to the Columbus conversation we had before. I mean, Columbus is unbelievable with industrial. The amount of warehousing they're building, it's incredible.
and now are they building them spec, or are they
so in Columbus they'll build them spec, and in Cleveland we have a few spec, but like when I say we have a few spec, it like dwarfs what Columbus is unbelievable. Columbus, we'll go to panels or go to discussions, and they talk about the Columbus industrial market, and it's crazy what's going on. They're very strong in industrial. I mean, they're a logistics hub. They can get to New York in 8 hours. You can get to Chicago. It makes a lot of sense why Columbus is dominating the logistics market. But Cleveland's not as much of a logistics like Columbus. We're more manufacturing in Cleveland, but we do have plenty of new warehousing for logistic purposes that have popped up, and there's plenty of Amazon warehouses, last mile fulfillment centers that have popped up, but we're never going to be the logistics hub for a lot of reasons. Mainly Columbus is 2 hours south of us, and they're really what makes sense for logistics, but we do very well with manufacturing. We've had a good amount of inventory come online and really be absorbed. I don't know. There's still some spec buildings that are being built now. I know there's one down in Seasons Road. They're building Fogg's doing that. I know, obviously, Geis has the Shalersville going up, and Scannell and Weston. They're doing stuff over by the airport. I mean, there's some centers that are. I mean, but what's funny is like there's like 4 or 5, right, that are maybe built. And not even, and maybe that's 500,000 square feet a year or whatever it might be going forward, which is nothing compared to the overall market. It's like less than 1%. So I don't get too worried about the spec builds in the industrial market, because I think it's still a pretty tight market. And a lot of those, they're sort of spoken for. So whether they're technically pre-leased or the developer sort of knows, like, yeah, I've got a tenant in my portfolio that wants to move. So the downside being it's sort of a typical Cleveland story of like, well, they moved from here to here, we never really gained anything. But a lot of times what you do see for industrials, they actually expand the square footage, right? So they might have been in 100 and now they need 2. So it is a gain for the market. It's just that 100 they were in, it's got to get either a new tenant or maybe repurposed depending on the location. But a lot of times they're able to backfill it because there's Cleveland has so much old inventory of all asset classes. So a lot of times it's your premier tenant goes to the premier building, your secondary tenant gets the old premier building that they left. So it's the constant flow of that. But no, industrial is doing well. I think it's a good asset class, and like I said, it's different than the headlines you read. Is more warehouse based, more logistics based, and we have some of that, of course, but we're more of a manufacturing sector. So we're not going to be as prone to the national headlines you might see. But yeah, that's industrial. It's a good asset. And one thing I do want to mention too, so one asset class that people don't think about is, and it's not necessarily an asset class that people think about because it's hard to hold these things, but development for single family for sale product, right? So your new construction of residential homes. It's done very well, even with rates rising. Now there's some things that go on in terms of your builder might be offering a lower rate than what's traditionally out there from a bank or whatever you're going to get your loan from, whoever you're going to get your loan from. So instead of maybe a 7% rate, you're able to get like a teaser rate of 5.5. You got to buy it down or whatever. But they're doing some deals there. But generally speaking, the market's done pretty well. And one thing I would tell you is we're in 2020 and 19, 20, 21, we were seeing maybe 4 to 5 houses absorbed within a subdivision a month.
Okay.
So, said subdivision, the developer, so you have a land developer in a subdivision, and then you have a builder. So the land developer sells the lots, the builder buys the lot and builds their house, and then they sell it obviously to the home buyer. So there's 3 parties that play in this whole thing. But the land developer is selling lots at, 4 to 5 a month in a subdivision, and some are doing 8 a month. Yeah, I'm sorry, not a month, quarter. So they're doing 3 to 4 a month. They're doing 12 a quarter, and they're doing really well. Now we're seeing a little bit of a slowing to maybe 2.5 to 3 a month. So maybe 2 to 3 a month is what they're getting, which implies maybe 7 to 10 a quarter, 6 to 10 a quarter, however you want to do the math. That's still pretty strong. Now you extrapolate that into what's the metro doing. The metro seeing, we just topped out at around 3,000 to 4,000 homes annually in our metro of Cleveland. That might sound like a lot, but you go back to pre GFC, pre 08, we were doing 10,000 plus. So
wow,
yeah, so we're never going to get back to that, but we're not building like a ton of homes that I get really concerned about that market. Now there's dynamics that people have to adjust, and lot pricing has to change. And I will say, you talk to the land developers, their costs to develop land are increasing substantially, like everybody's seeing, generally speaking. But
sure.
land development, I'm seeing some significant increases in the cost to develop a subdivision, to develop the land, to sell the lot. So they're seeing some major increases, which can be concerning, because then obviously you have to sell your lots for more to the buyer, which is the builder. And then the builder's like, hey, I don't know if I can sell my house for that much more. So everybody's profit's getting a little shrunk. I mean, I'm seeing builders willing to pay a little bit more because, hey, keep the machine going. And they understand, hey, I used to, if I develop land, I mean, I just had a land developer this week call me and say, we literally had to tell the buyer, we'll just stop, because if we sell the lots to you at this price that we're doing, we're not going to make money. So we'll just stop,
Wow.
and he wasn't like, playing hardball. It was, I saw the numbers. It's true.
Yeah.
And it
Wow.
happened. So, but the home builder, they adjusted the sale price. And I didn't see them increase their home pricing that much, but they're, generally speaking, the subdivisions are doing well. They're like I said, historically, they're so far below what we used to do. It doesn't mean that we should be building 10,000 plus. That's obviously not what we should be doing, but there's just not so many homes being built that it's like, oh my gosh, this is crazy. And, again, that's another function of, we've mentioned it before, but Cleveland's got old housing stock. They have older construction across all asset classes, but one of those major asset classes being, residential homes. We have so many houses built pre-60s, that, folks want a newer house. And really what's a major driver of subdivisions is retirees wanting a ranch. Your builders, they used to build the 2-story homes everywhere, 4-bed, 2-bath, whatever it might be. Everywhere they built it was a 2-story, 4-bed, 2-bath, 2.5-bath, whatever it might be. Now you're seeing a ton of ranches, 3-bed ranch, 2 baths. That's what they're seeing. So the ranches are really dominating a lot of the new construction, because I hate to call them seniors, but you're 65 and older, that's what they want. They want single-story living, and that's really what's been absorbing a ton of the new buys. So it's been a cool market dynamic to see.
That's very interesting.
Yeah.
I'm a big ranch guy, so I like that. Yeah. All right. So last but not least, multifamily.
Yeah.
I know we kind of been weaving some multifamily themes the last year and moving forward throughout the conversation. But any kind of final thoughts on to how you think this market will look for us with your crystal
I think
ball?
multifamily is still it's still an attractive asset class for investors, right? They like it. And again, there's a mismatch still in the valuations in terms of buyers and sellers. But I do think it's a strong asset class. It's going to continue to be. We have solid fundamentals in Cleveland. I will say, we're seeing we saw in 23 a little bit. I think it was not. I think I mean, I don't know everything, but the the reason why we saw a little bit of a dip in the vacancy for apartments in 23, we saw some apartments dip, maybe sub 90 even percent
Mm.
occupancy.
Hmm.
And that was more of your newer, your class A type buildings that, if they were, a year post construction, so they try to complete their lease up. They were more 85, 90% occupancy, it seemed,
Hmm.
for when I would talk to a lot of them. But that's a function of, we had quite a bit of inventory come online in 22 and 23 that
Sure.
just had to be absorbed. So I talk with leasing reps, I talk with, investors and owners and whatnot, and they're all seeing across the portfolios an increase in occupancy. They're seeing an increase in foot traffic for potential tenants. And obviously, I think I think when I talk to leasing reps and owners and whatnot, the summer of 23 was like not a great leasing year. Usually the summer in Cleveland is when you get a lot of new tenants, or that's when a
Big
lot of
leasing
units start to be
season.
absorbed. You get
Yeah.
like, the clinic has a lot of their residency matches, and same with UH and Metro for that matter. A lot of the medical, which is a huge job generator in our market. That's when we get some of those new jobs. So the summer in 23, I think it was just a lot of inventory came online, and there wasn't as much demand as what was needed for the inventory that year.
Hmm.
But they're much more optimistic, and they're much more believing that they'll get back to maybe 90 to 95% occupancy, if not better. So they're all hoping obviously to be fully occupied. But your class A new construction type product, I think, it was more 85, 90% in 23 occupied. And I think you're going to see much more 90, 95, and not, if not higher. And that's a good thing for obviously for everybody. But I do think we'll see maybe that headwind from 23 start to dissipate a little bit.
How about the expenses?
Oh,
Which
yeah.
has been, I know, a huge challenge for operators, for
Yeah.
folks looking at deals.
Yeah.
Insurance is brutal. Overall
Insurance.
expenses I know are rough. What are your
Yeah,
thoughts there? How does the industry
insurance
pivot?
rose significantly. Yeah, insurance was a big increase. I mean, even utilities went up. So yeah, I mean, across the board. Yeah, obviously, if you got repairs and maintenance for an apartment, your labor costs went up, your materials went up. So across the board, expenses frankly went up, and rent didn't really go up that much to make up for it. So it was a tightening for them, but rent had run up so much before,
Mm.
like,
Mhm.
so there was a major rent increase significantly, and expenses didn't go up nearly as much. I think expenses are starting to catch up to that rent increase.
Mm.
Um, but yeah, expenses, insurance obviously was a huge one, which always drives me nuts because that's not, it frustrates me as a Clevelander. We don't have these like crazy, uh, natural disasters that happen that really can screw up our insurance rates. But I think we're getting the rewards of other markets having some significant issues in there in terms of hurricanes and whatnot. And I
Mm.
know I think insurers are trying to isolate that more, so they're not trying to pass on everything to everybody. But there's nonetheless, like, we're seeing it. And obviously, another function is, it's not just, they had a lot of claims in the last few years, that's why insurance went up. It's obviously also a function of the replacement cost has gone up, right? So to insure a building, if it were to be fully damaged, the insurer's paying out more than they had to a couple of years ago, so they have to raise the premium. So it's a whole function of that insurance market. But yeah, insurance went up, sometimes even double. I mean, it was,
Oh, I
you know,
had it prohibit deal. I mean, it prohibited a few deals last year.
yeah, yeah, which sucks to hear, but it's something that I'm not shocked either to hear. And yeah, insurance went up, and I think Yeah, utilities went up, not as crazy and drastic, but utilities, we saw an increase in utilities overall, and we definitely saw, your repair, your labor and whatnot, that increased as well. So yeah, it was definitely not a fun year on the expense side, but uh, historically, it's just maybe catching up to the rises in rents that we saw. So,
Okay. Okay.
Yeah.
Good. Good. Yeah, I think this is a fantastic combo. Any final thoughts as we kind of wrap up here?
I think one thing, just while I'm here, and talking to you, and you got the audience, is one of the things we're seeing in our market is obviously, how do you project taxes in Ohio? It's difficult, and
Hmm.
Most of the brokers and the lenders that we deal with, they're all very good. They all project something in terms of the exposure that you might have. And I know the state laws are changing, and I don't really know how it's going to play out. I think it obviously tilted the benefit to the land to the owners of the real estate, but there's always that exposure. And I think, that's one thing where there's every once in a while we'll see some underwritings done where it's like they don't even understand the tax exposure issues that you have. So obviously, if you're working on a deal, and you're doing, I would just say, try to bake in a little bit of an exposure. A lot of times I always tell folks, hey, if you don't underwrite your deal to be optimistic in every single data point that you put in, right? Like if you just, not, you don't have to be ultra conservative, but like don't be ultra optimistic that rents are going to be so much higher and expenses are just going to be the same. It's like that doesn't always happen, right? So if there's one thing I could say, it's again, in our market, I don't have to deal with it that much. But you talk to other appraisals in the markets, and they have to deal with it a lot more, and that's these unrealistic underwriting from whoever it might be, and it's again, it goes back to rents are going to double. It's like, okay, and again, we don't necessarily have this so much, but I always appreciate, working with guys like yourself and honestly, most of the participants in our market, they all have a good understanding of the nuances of at least our Cleveland, Akron, Youngstown, Northeast Ohio market. And I do know, like I said before, that debt service coverage ratio, if there's anything that I'm hearing more than ever in 23 and into 24, it is definitely that debt service coverage ratio is something that is affecting deals.
Oh yeah.
You keep hearing values are there, the debt service isn't there, right? And again, that goes back to your debt service coverage ratio has increased, your interest rates have increased, and therefore it's a double whammy on the back end. So we're constantly trying to get feedback from all types of participants. We're also seeing another thing that we're seeing is debt assumption. So we're seeing a lot of folks buying an asset with debt assumption. On the appraisal side, that's a favorable, essentially, we would call that favorable financing. So we have to adjust that sale. If we want to use it as a sales comp, we have to adjust that sale to meet what the current market rates would be. So if you're assuming debt on an asset buying, and let's just say the rate's 4% on that debt, and you got 7 years remaining because it was a 10-year deal or whatever it might be, we have to adjust for what's the normal market terms, right? If rates are 7%, you got a 3% benefit on the rate, but somewhat mitigates. You only have 7 years left, where maybe a normal terms 10. So we have to do kind of like a present value calculation of what's that benefit and deduct it from the sale price to use it as a comp for a typical market transaction, right? Which is what we're appraising. So it is something that we'll probably see more of is debt assumption, because there's attractive debt. There's attractive debt. So just a heads up, appraisers do have to adjust for that debt assumption, and it's not a major it's not like a major, oh man, it's a 20% adjustment. It could be below 5%. It could be maybe as high as 10. It really just depends on how long was that debt in place for, how many more years remaining, how low was the rate. But there's adjustments that have to be made on our end for that. So,
That's interesting.
yeah, and
I
again,
talk to folks looking in the market all the time, and oftentimes the first question is for a particular opportunity is there debt and can I assume it?
yeah, and I think that will move some deals, right? And I do think you'll probably see some investors that maybe, you know, depending on how they sort of got into the deal and what their underwriting was at the time, they might be essentially selling it with no equity, but they're getting out from the debt. But the basis for the next guy is such an attractive debt position at that point. That's why I don't think it's necessarily doom and gloom everywhere, but I do think that there's going to be some folks that just frankly don't make money because they don't have equity. And it might have been because they either overpaid, they assumed too high, whatever it might be. But I do think that the debt can be attractive, like whatever the existing debt is on a property, that debt can be attractive to as a basis level, right? So you might owe 10 million. Well, I'm going to pay 10 million. So you're getting out with zero, but it's better than negative. And I think that's going to be some stories you probably see, right? And there's definitely going to be some guys that are going to have to maybe scratch a check at the closing. I mean, it might have to happen, but the good news, I guess, in a weird way, is the debt that's out there is attractive because if it was made a couple of years ago, it's an attractive debt. Yeah, so that can get deals moving. And I don't know if it's going to be as doom and gloom of, banks having to really take back assets. It's always going to happen. It happens in all the time. It happens, right?
Every cycle.
Yeah. So that's still going to occur, but I do think it's not going to be awful. And I do think that there's going to be some deals in terms of assuming debt. For sure. A good participant.
Deals that make sense. Yeah. Favorable deals.
Yeah. They're going to look at that debt and say, well, I'll take your debt. You can walk away from it. And the seller might say, hey, that's the best news I heard. And let's make a deal or, whatever it might be. Right. So I do think we'll probably see that. I think debt assumption will be a big driver, especially in multifamily, given the Fannie Freddie deals that are out there.
Sure.
So yeah, no, that'll be, I guess that's another, that's another thing that I'm excited to see happen in the market is sort of how that plays out as debt assumptions. And again, I know I mentioned earlier, but tax abatement is another thing that it'll be interesting to see how that plays out. But yeah, I think the market's holding up, whether that's on extremely strong footing or not, is to see. But I think our market in Cleveland should be okay. I don't think you're going to see crazy things happen, but you never know, right? I mean, we never know.
You never know. I wish you had a crystal ball. I wish I had a crystal ball. Make life easier.
Yeah, well, you'll know I have a crystal ball if you see me out there doing a bunch of deals for some reason. No, it'll be. I think we'll have a good 24, and I hope everybody does. Right? I want that thawing, like you said earlier, to start to happen. I think it'll be good for everybody. So.
Well, Tim, thank you, man. This was wonderful. I appreciate it. Again, to our listeners out there, Tim is always accessible. His website is irr.com/Cleveland. Tim is also active on LinkedIn. You can reach out to him there. We'll also provide his full contact information where this podcast is posted. Tim, thanks again. Appreciate it.
Yeah. Thanks, Peter.